Hey everyone, good afternoon. Welcome back to another webinar here with the Exit Planning Institute. My name is John Weissar. I'm the member experience team here at EPI. Excited to host the webinar today and bring in our guest, Mark Russell, to talk about ESOPs as an exit planning strategy. Just a little background here before I turn it over to Mark. He is head of the finance group at SES ESOP Strategies. Works extensively with business owners, evaluating their situations, their goals and objectives, and assisting them in preparing for a succession of an exit from their businesses by performing an analysis of alternatives, so including ESOPs, and that's the main strategy he's going to talk about today. So with that, would like to turn it over to Mark to talk about today's topic.
Great, thanks, John. Appreciate that. We'll get started here. Just as an agenda, we're going to talk about some potential strategies and how ESOPs fit into that. We'll define what an ESOP is and talk about the mechanics of the ESOP, talk about some benefits and risk of the ESOP to the different constituents, including the selling shareholder, the company, and the employees. Talk about an ideal ESOP candidate. And what I promise you is we will not go through an overview of our firm. That's in here, but we will conveniently not have time to get to that today. So let's get started. Potential ESOP, potential strategies. So this is a chart that we like to show just kind of as an overview of why some people might consider an ESOP, the difference in an ESOP and other potential strategies to exit your business. So here we have 7 different ways that a business owner could exit their business, including on the left, a gift or an estate transfer to family, sale to insiders, the sale to the ESOP, a third-party sale as a minority transaction, a third-party sale, 100%, and an IPO. And the way some people have categorized this chart, and including me at one point in my life, is I kind of looked at it as the least value on the left to the most value on the right. In other words, if you were valuing the company as a multiple of the value, you know, if you're giving it away in your estate to your children, you know, you're really not getting anything for it other than the benefit of giving it. Sale to the family, you're usually taking a big discount. Sale to insiders, a discount. And all the way up to an IPO, which most of us with the business owners we're working with don't really have the opportunity to sell to an IPO, but you're probably going to get the highest valuation on an IPO. And so people would say, well, why not always do the third-party sale? And that could either be a sale to a private equity firm or a sale to a strategic buyer. And what we found is because the ultimate value of the business is not just the cash consideration or the multiple of EBITDA that gets paid. It's what are the other goals and objectives of the business owner. And we named a few of these, including maintaining family control. Obviously, if you do a gift or estate transfer, you're going to maintain more family control than an ESOP or a sale to a third party. Incentive and reward management. Obviously, an ESOP works well with that, as well as rewarding the employees. Minimizing cultural disruption. Again, along the spectrum here, different things are worth, you know, different values here. And then legacy of the firm. And I guess one of the best ways to demonstrate this is probably with an example. A company that I worked with before I started doing ESOPs. It was a large company, manufacturer here in the United States. Very, very powerful brand name, well known. And the business owner was ready to exit the business, didn't have family in the business and wanted to sell the business. But the business owner did have extremely tight ties in the community, religious-based, mission-based owner and company, wanted to reward not just the employees, but also, you know, give money to his church and take care of the community as well. So he decided that he was going to sell the company, but he wanted to make sure that those things were taken into consideration. He ended up at the end of the day with 2 different types of buyers for the business. One was a private equity firm who was offering a good return and was talking all the right talk about understanding the cultural and legacy goals that he had. The other was a manufacturer who, frankly, was a foreign manufacturer, said that they couldn't get the margins that they needed if they continued to manufacture in the US. So the business owner decided that he would sell to the private equity firm. And in that, he did several things. He took 10% of the proceeds and put them into an incentive plan for the management. So he took care of management. He also tied 10% of the proceeds to his church, trying to take care of the community. And he required that the private equity firm agree not to sell the business for at least 3 years. Well, you can imagine what happened after 3 years. The private equity firm ended up selling that same manufacturer, the strategic buyer that had made an offer before, did very well in the sale, and ultimately the manufacturing was no longer in not only in his local community, but not in the United States anymore. I think, you know, he did what he could to protect the employees and the community at the time, but if he had known about an ESOP, I'm not saying that he would have done that route, but it would have been something else for him to consider for sure. So we just want to make sure that ESOPs are on people's minds and people are thinking about ESOPs and why someone might consider an ESOP versus just an outright sale of the business to a third party. So what are some of the strategic alternatives that a business owner has? Won't spend much time here. I know most of us are CEPAs, so we kind of understand these different alternatives. But the point that I wanted to make here was that an ESOP is a potential alternative with a lot of different ways that a company can go strategically, including acquisitions, including a minority sale, and a complete sale of 100% of the company. So an ESOP can be part of many different types of transactions, including a growth strategy. So next we'll get into what exactly is an ESOP. An ESOP is an employee stock ownership plan. Sometimes people will say employee stock option plan. An option plan is very different in that it can target individual employees. An employee stock ownership plan, however, needs to be broad-based. Basically, all employees will participate, at least all US employees will participate. There are some exceptions, but for the most part, it's a broad-based plan. So everyone needs to participate, and you can't discriminate against lower paid employees. So similar rules to what you might see in your 401k plan. An ESOP is a tax qualified retirement plan for employees. And by law, it invests primarily in employer securities. Congress structured it that way, specifically to encourage ESOPs. ESOPs date back to 1974 when it was originally codified. So we're coming up on the 50th anniversary. And honestly, all the legislation that has been coming out for at least the past 10 years has been very positive to ESOPs, continuing to expand some of the benefits for ESOPs that would continue to encourage business owners to utilize an ESOP in exiting their business. It is a defined contribution plan. Each participant has their own account balance, like a 401k plan. Again, they've been around for a while, and the IRS and the Department of Labor regulate them like a 401k plan since they are tax qualified retirement plans. So a lot of people tell us that, you know, they've been hearing more and more about ESOPs, and I think that's right. And it's why are they more popular now? I think there's a variety of reasons for that, but we'll go through a couple of what you know, we believe anecdotally why we're seeing more ESOPs and more business owners thinking about ESOPs. So first, on a national basis, ESOPs are a very small percent of the total companies that we'll consider could be eligible for an ESOP. That is companies with 20 or more employees. It's less than 1% of all companies with 20 or more employees. So what are the general motivations? Again, of course, we have the retiring baby boomers who, you know, the silver tsunami, 10 trillion plus worth of businesses that the assets will exchange hands over the next couple decades. So one way or the other, a lot of businesses are going to be exchanging hands. So ESOPs are obviously one of the ways that can happen. So we're seeing more of them just as more boomers are retiring and businesses are being transferred. The other thing that we see, and there are some studies that back this up, which is that there are fewer family members in businesses today than there were, 40, 50 years ago. I think it may be partially because boomers' attitudes toward their children and their business has changed a little bit. I think some boomers are wanting to see their children pursue their own interest, but whether they desire or not for their children to follow in their business in their footsteps, the truth of the matter is there are fewer families that are transferring the business to the next generation than there were, again, 40 to 50 years ago. Next, we'll go through what an ESOP is not. And if you've heard a myth that you want to address, please punch in the question there in the chat box, and John will read those to me as well. Since this is not a webinar, I'll just go ahead and give you some of the ones that we've heard and tell you why we think it's a myth and shouldn't be as much of a concern as perhaps people make it out to be when discussing an ESOP. So the first myth is the owner is giving away the company to the employees. And that's not true. The owner is selling the business. He is, of course, like any sale transaction, giving away the future appreciation of the business because we're setting a value for the most part today. We can do minority sales, which we'll talk about a little later. But for the most part, what we're doing is we're saying, okay, the business is worth X today. We're trying to find out how much cash the business can come up with to pay that price, to loan to the ESOP to pay that price, and then how much needs to be financed outside of the qualified assets or cash flow of the business. And that's usually funded by the shareholders themselves, but they are getting paid the value based on today's valuation. The ESOP trustee cannot pay more than adequate consideration, which is fair market value determined by an independent appraiser. It's the normal definition of fair market value, willing buyer, willing seller. However, in this definition, it does not include the synergies that could come with the business. So if a strategic buyer could cut out a lot of the cost, or if they could enhance their revenues, they might be willing to pay more. An ESOP trustee cannot pay that because they're not going to recognize those synergies. They're going to continue to run the business as a standalone business. So that's the one definition. So we always say, look, if you were to run a competitive sales process, getting the best buyers in and having them compete with each other, you probably could get a better price as far as valuation goes. However, it's often close, and the tax benefits both to the shareholder as well as the company can often exceed the difference in the value of the business. So we think that, again, it's not necessarily for everybody. The value might be higher for some people other ways, but it should be considered and looked at, and to determine whether the tax benefits make up for any difference that might be there from a value perspective. Another myth is that employees can examine the company's books and records, know how much money the owner is making or family members that may be in the business are making. And that's just not true. The participants do receive a statement every year showing the number of shares they own and the value of those shares, but detailed financial information is not required to be disclosed to the employees. There will be a trustee who is a fiduciary for the employees, but that fiduciary does not disclose that information to the employees, and the company has no obligation to submit any of that information to the companies. Now, some companies, as a matter of culture, will decide to give more detailed financial information to employees. especially after they become an ESOP, because they want to show the employees what drives the value of the ESOP, what's driving the value of their retirement account, what they as employees can do to improve their performance that will have a direct result on their retirement account. So some people do, but it is not required. Another myth is that the owner will lose control of the company. There's two different things to talk about here. One is if the owner maintains majority ownership, they still own a majority of the company. They can still elect the board of directors and they still control the company. So oftentimes, probably somewhere around 40 to 50% of our transactions result in the first stage of an ESOP is a minority transaction where the owner is not selling 100% of the company. They're selling enough of the company to take some chips off the table, to de-risk their personal balance sheet, to do some estate planning, to set up a potential buyer for the business someday, because now you have an ESOP in place that if it buys, let's say 35% of the company in the first transaction, if something should happen to the owner unforeseen, now the family has a minority owner that's already in place that can buy the remainder of the business. And so going back to the myth of losing control of the company, even when the ESOP buys 100% of the company, the owner still has a lot of say in the company. Typically, the owner will remain on the board of directors until at least their seller note, which is part of the financing of the transaction, is paid off. That can be anywhere from 5 to 10 years down the road. And in the ESOP trustee, it's an interesting relationship because they certainly are the legal owner of the stock. They have a fiduciary duty to the employees, so they need to act in the interest of the employees, and they vote the stock to vote for the board of directors. But the board of directors also has an obligation to make sure that the ESOP trustee is doing their job properly, and the board of directors can hire and fire the ESOP trustee. So it's sort of a symbiotic relationship. And in most companies where the company is well run, there's really no issue at all about the trustee and control. It's the company looks and feels largely like it did the day before the transaction, from who's management of the company, who's making day-to-day decisions for the company. The final one that we have here is significant transaction cost. There are transaction costs, of course, as with any exit transaction. What I can tell you is they're typically significantly lower than a third-party sale transaction using an investment banker or a business broker. And the advantage with the ESOP, of course, is you also have significant tax savings in not only setting up the plan, but also going forward with the plan that more than offset the cost of the ESOP itself. John, I don't know if you had any other questions come in there that might be a good time to discuss.
Yeah, I've had a few. So a lot of people are actually very interested in the slides. So if you're willing to share those after the webinar, that's totally I've gotten a lot of people asking about those.
Sure, we can do that.
Perfect. A couple of recent questions here. Will's asking about what restrictions are there on the percent that must be sold when selling to an ESOP, and what restrictions are there on that company sold to ESOP later being sold to a strategic or other form of transaction?
Yeah. So the first question is, I guess I'll give you the lawyer answer, right? It depends. So if you're wanting to take advantage of Section 1042, which is the seller's deferral of the gain on the sale of the stock, we need to have a sale of at least 30% of the company to the ESOP. So that's, a lot of people think of that as the minimum, but sometimes 1042 doesn't make sense. For example, if the sellers have really high basis in their stock, 1042 may not make sense. So 30% if you're doing a 1042 transaction, no minimum if you're not. And then as far as what impact it has on future sales, I will tell you that our group sells probably 2 or 3 ESOP-owned companies a year to third parties. So it is something that's definitely done. There's no prohibition on selling an ESOP-owned company. The difference is we do have an ESOP owner, the trustee, who is a fiduciary for the employees. So we have to get their sign off at the end of the day. And again, it's, really in some ways no different than any other business owner selling the business. They have to believe the value is there to sell the business, or they shouldn't be selling the business. Here, it's just that it is a third party. They're going to have to go to their independent valuation firm. They're going to have to get a fairness opinion. So there are some more hoops that we have to jump through. But again, like I said, we represent either companies or ESOPs that sell probably 2 to 3 times, or 2 to 3 companies or ESOPs that are selling the stock a year on average. And it's just something that we have to work through, but it's not a prohibition. And it almost always turns out in a successful transaction if it's the right thing for the business. A lot of people will use the ESOP as a shield, though, in a way, because they don't necessarily want to sell the business to a third party. So some third parties will come in and say, hey, we want to buy the business for all those reasons we discussed earlier: culture, legacy, et cetera, et cetera. It may not be that the management and the board believes that the right thing to do is sell the business. So they'll sometimes set it up that it's the ESOP that creates a big burden to selling. But in reality, if it's a good deal, if it's a well-structured deal, the trustee it's in their best interest and their fiduciary duty to do what's right for the employees, which if it's it's a good deal, they sell. If it's not, they don't.
Perfect. There were a couple of follow-ups to that. So there's a couple of primary questions that have come through, but there were a few follow-ups to that, what you just explained. So one of them is talking about, is section 1042 only for C Corps?
Section 1042, in order to elect 1042, it has to be C Corp stock that gets sold to the ESOP. But don't get too caught up in that, because as an S corporation, we can always elect to become a C corporation. We may have a 5-year waiting period before we can switch back to S again. So we can elect to become a C corporation, and same thing with even if we're a partnership. Again, more tax analysis that we'd need to do, but we can go from a partnership to a C corporation. We just have to make sure we do it the right way to make sure that we get the right carryover basis, et cetera, and ultimately get there. But those are to the extent that there's taxes that are a negative in that analysis, we just have to weigh that against the positive of being able to elect 1042.
Okay, and then there was one more related to what you were discussing. So if the company post ESOP wants to acquire another company, does the company have to comply with any special requirements such as trustee approval if stockholder approval is not otherwise required, for example, assets for cash?
Yeah, so for the most part, you can do acquisitions as long as you're not using the company stock. It's a board decision at that point. I will tell you that most companies that we work with, whether they're required to or not, they have the conversation with the trustee. They explain the business reasons behind why they want to make an acquisition. The trustee can tell them whether they think they need to have formal approval of it or not. Typically, again, for an asset purchase, they wouldn't need to have formal approval of an acquisition. But it's good business practice just to keep your trustee informed of what you're doing and why you're making those business decisions.
Perfect. Okay. There were a few more in there, but I think those can be answered towards the end. So I'll let you get back into the presentation here, and we'll save those for later.
Okay, great. Thanks. So we'll talk about different types of ESOPs now and kind of talk about the transaction itself. So generally speaking, there's three types of ESOPs. One is called a non-leveraged ESOP. This is where the employer makes a contribution to an ESOP. It can be made in cash or it can be made in stock. If it's made in cash, they make a deductible contribution to the plan. The plan turns around and buys stock from the shareholder. So it's a pretty simple transaction. The other thing they can do is they can just make a contribution of newly issued stock directly to the ESOP, and they take a tax deduction for the value of the shares that are being contributed. Again, pretty simple transaction. The problem with the non-leveraged transaction is it's very slow, and you don't get a lot of tax benefits up front. What most people do is what we call a leverage transaction, where we can do a larger transaction up front. Here, what we do is the ESOP effectively borrows the money either from the company or from the shareholders or a bank, but it's usually through the company, and buys a large chunk of stock up front from the shareholders or from the company. And then over time, the company makes deductible cash contributions to the ESOP, and the ESOP uses those to repay the loan. So the ESOP ends up with a lot of stock up front, which is good for several reasons that we'll go over in a minute. And then they pay that down over time. And then the final is a blended, which is a combination of the two, where some contributions are made in cash, which is held for future purchase. And then eventually the ESOP leverages the remaining balance. So what is an ESOP? We've talked a lot about what an ESOP is not. So what is an ESOP? It's an instrument of corporate finance. It's a transaction where the shareholder's sale of stock can be tax deferred. We talked about 1042 earlier. It creates a buyer for shares in a closely held corporation. So you don't have to go out and try to find a third party. We're actually creating the buyer in the ESOP transaction. It provides market support for some micro cap public companies. There are some regional and community banks who have ESOPs. That's a popular strategy to provide basically market support for their stock. The shares end up in, we have quotes here, friendly hands. The company can essentially deduct the principal, can deduct interest, of course, also, but can deduct the principal that's used to purchase the stock. So over time, the company borrows money, it gets a deduction for that. And eventually the company and the shareholders can operate the business essentially tax-free from a federal and most states income tax perspective. So if it's an S corporation, it's owned 100% by the ESOP, the company and the shareholders going forward will not pay any income tax. So from a competitive situation, from a cash flow perspective, it's a huge advantage. Obviously, this tax shield, and it's not a tax loophole. It's not an unintended consequence. It's very much designed into the tax code that Congress enacted to encourage business owners to sell their business to employees. I said earlier, ESOPs have been positive legislation, and this is from both parties in Congress. Here's some legislation that's pending currently, and obviously had a lot of Republican and Democratic sponsors and co-sponsors. So it's maybe one of the few things that has bipartisan support in Washington right now. So next, we'll talk about the mechanics of an ESOP. And again, we'll show the non-leveraged ESOP. Again, this is not the the way that most people do ESOPs, but it'll help in our explanation of the leveraged ESOP. So here we have the parties. We have the company, we have the shareholders, and we have a ESOP trust, a newly formed legal entity that, again, we created for this transaction. So here, the first step is the company makes a deductible cash contribution to the ESOP. So it takes, let's say, $1 million and contributes it to the ESOP. It gets a deduction for that $1 million. The ESOP the cash is contributed and allocated into employee accounts. So each employee now has an account balance. And then the ESOP uses that cash to purchase stock from shareholders, or it can purchase it from the company if it desires. So if the $1 million represents 10% of the company, maybe instead of all the shareholders selling 10% of their stock, you just have the company issue 10% new shares and the shareholders get diluted down. But at the end of the day, what ends up happening is the company winds up with a $1 million tax deduction. The ESOP now owns, in my example, 10% of the company, and the shareholders now own 90% of the company, and that's it for this transaction. So again, pretty simple transaction. This is something that can be done annually, but again, it's a slower process. This just explains what I just said, so we'll stick around on this. Next, we'll talk about the leveraged ESOP. Again, more boxes here. We've included a lender in this example. So here, first step is company borrows money from the lender. Let's instead of the $1 million example, let's use a $5 million example and assume that the company's buying 50%, or that the ESOP is buying 50% of the company. So $5 million borrowed from the lender, loaned to the company. Company loans the $5 million to the ESOP trust. The ESOP purchases $5 million worth of stock. So in this case, 50% of the stock from the shareholders. And then every year going forward, what's going to happen is the company is going to make an annual cash contribution to the ESOP. Again, fully deductible cash contribution to the ESOP. The ESOP that same day is going to turn around and make a loan payment to the company. So let's go back to our example. If it was a $5 million loan originally, and the company pays $1 million on the contributes $1 million, company gets $1 million deduction. ESOP repays the $1 million same day, and then as of the repayment of that note. So when step 5 occurs, when the ESOP trust repays the money to the company, it's now paid off 20% of that loan. So on that day, the ESOP is going to, we call it, release the shares from a suspense account. So prior to the loan being paid, those shares are being held as collateral for that loan. And they are not in any individual employee's accounts yet. It's not until that loan is repaid in step 5 that the shares get released from the suspense account and get allocated to the participants account. So now at that point, the employees have balances in their ESOP. And then the company can, of course, repay that loan back to the lender. So that's the way a leveraged ESOP works. Again, I did the example of borrowing $5 million from the lender and doing a 50% transaction. Another option would be to borrow $5 million from a bank and borrow $5 million from the shareholders as a subordinated loan, so that the ESOP can buy 100% of the company on day 1. Then we're going to pay back the same way. Probably the first, $3 to $5 million we're using to pay back the lender as the senior lender, and then we're going to start paying back the shareholders, obviously with interest and perhaps stock warrants as well, because they're a subordinated debt holder. But at any rate, we can use this structure to do a minority transaction or a 100% transaction on day 1. So again, leveraged ESOP, this is kind of what I just described. Company loans directly to the ESOP. just goes through the steps here. Again, oh, one other thing is in this example where we're paying the loan back, we can pay that loan back over any period that we want. So in the first example, I think I said we'd pay the loan back over 5 years. Here, we might look as far out as 10 or 20 years to pay that loan back from the company, from the ESOP to the company. That doesn't mean that we'll pay the lender back over that period of time. We'll probably pay the lender back more quickly, but it gives us a longer period of time to allocate those shares to the ESOP trust. One of the things we don't want to do is be in a situation where all the shares are allocated too soon and we don't have shares for future employees. John, I saw you pop back up here.
Yeah, one of the questions based off of this, I'm pretty sure you just covered about, answered one of the questions that was in here about the wages from the 1 million and 5 million contribution. You pretty much just covered that. Corbin asked though, other than tax deduction, how is an owner getting compensation from this?
Yeah, so the owner is getting compensation in this example. What we just discussed, they're getting $5 million up front. So again, the money's coming from a bank to the company, loan from the company to the ESOP, and then the shareholders being purchased $5 million of their stock day one. So they're taking some cash off the table. And that's obviously an important part of the overall transaction, is to make sure that the shareholder is getting something up front, de-risking their personal balance sheet, again, setting up estate planning, et cetera, et cetera. The other way, again, in 100% transaction, well, I guess I should say two ways. If all they're doing is 50% up front, they can do this transaction, wait 5 years and do another transaction, another 20% or another 50%. So eventually they get all their shares bought out that way if they do it in steps. The other way is they do 100% up front and the shareholder takes the note back themselves. So the bank gets paid back, but the shareholder also gets paid back. The good thing about that is the shareholder is entitled to a fair and reasonable market rate of interest. So in today's economy, that can be, anywhere realistically in an ESOP transaction, probably in the 10 to 12% range. That can either be current pay or it can be a combination of interest and warrants. So we often see the shareholders that are selling the company will end up with stock warrants, which work like stock options, that are worth, could be worth 15 to 20% of the value of the business. So even though they sold 100% of the business, they still have these stock warrants that may be worth 15 to 20% of the business as a second bite at the apple, because they're providing this subordinated debt, for providing a valuable resource in making this transaction happen.
Perfect. One more, and this is a good question related to everything. Larry asked, so given the lending issues with regional banks due to the assets being underwater, where do you see money coming from to provide the ESOP with funding?
Yeah, so it's certainly an interesting market out there right now. Some businesses I know are having a more difficult time. I know a lot of construction is having a difficult time. Real estate is having a difficult time. So it really depends on the industry. It depends on the business. A lot of businesses are not, and banks are still very willing to lend money at aggressive terms and conditions. One of the things I should mention is the standard in the ESOP world is that the shareholders do not provide personal guarantees on this bank loan. So it's very different from a lot of other transactions, or a lot of certainly a dividend recap. Shareholders typically do not provide personal guarantees. That's one of the things we work with the business owners, make sure that they're getting a fair and competitive terms from the lender. We have some information in the back. I'm not sure that we'll get all the way to it, but one of the things that a lot of banks have realized is that ESOP owned companies perform a lot better in down economies than non-ESOP owned companies. There's lots of reasons for that, but at the end of the day, defaults on ESOP owned companies are significantly lower than non-ESOP owned companies. And a lot of regional and national banks have set up ESOP groups within the bank that are specifically set up to try to encourage ESOP lending, and they want to lend to ESOP-owned companies. And so we've had a lot of success of finding the right lender for companies that want to do ESOP loans. So we'll certainly help with that.
Perfect. Thanks, Mark.
All right. So again, we went through that. I'll go through this pretty quickly. So this is just our transaction timeline. People often ask, how long does it take to implement an ESOP? And the truth of the matter is, it can be a little shorter than a third-party sale, but typically, it's a 5 to 6 month process, especially if we're raising debt from a bank. We're doing a competitive debt raise process. That takes some time. We need to engage the trustee. They need to do evaluation. All this is pretty time consuming. So typically, 5 to 6 months is what we're looking at. The one thing I can tell you, having done what I'll call investment banking, third-party sale transactions for many years and doing ESOP transactions now, is the likelihood of a successful transaction is much higher in an ESOP transaction. So whereas, a lot of times with the third-party sale, you'll go through these first 3 phases, and in the final stage, we'll be doing, final due diligence and transaction documentation, and deals will fall apart. Much less likely to fall apart in the final couple months in an ESOP transaction. So a lot of people look at ESOPs that have been through that process with a private equity or a strategic buyer, and do not want to go through that again for obvious reasons. And that's one of the things that they find attractive about an ESOP, is the likelihood to close is much higher in an ESOP transaction. I won't spend a lot of time on these, but just a couple of examples, case studies that we have, and these are on our website as well. And as John mentioned earlier, we'll share this deck. Mitchell Martin was a transaction that closed earlier this year. It was a very large staffing company. Sorry, lost the word there for a minute. A very large staffing company. They wanted to do some estate planning and some sale, but really important to them was the cultural piece. The founder was a socially minded founder, wanted the workers to have a stake in the company, wanted them to be owners in the company to drive the future of the business. So they did a minority transaction. So they sold less than 50% of the company to the ESOP. Again, very, very satisfied at the end of the day with not only the financial pieces of the equation, but also the social pieces of the equation. Another transaction that we did recently was MJM Architects. Again, architectural and engineering firms are one of the largest segments of the ESOP space. Professional services firms like that are often good fits because the employees are the assets of the business, and whatever we can do or whatever they can do to retain and recruit employees, it helps their overall business. So MJM was another one. And then I'll try to shoot through these because we want to leave about 10 minutes for questions. So again, 1042, pretty obvious what the benefit here is. The no capital gains for the seller. So here we showed a transaction where there was a discrepancy of $2.5 million in the purchase price, but that was more than made up for in the tax savings from the 1042. Won't go through the details there. So the other benefit that we talked briefly about is the deduction of the purchase price of the stock. So again, this is comparing to a dividend recap where we borrowed $16 million in both cases, but in the ESOP scenario, we're able to get a deduction over a 10-year period of time. So we got a $3.5 million PV of the benefit, PV of the cost were about 500,000. So effectively, getting that $16 million to the shareholders cost $3 million less on an after-tax basis in the ESOP scenario. And then the last one we'll talk about is the S Corp, which has two benefits. One is the actual deduction itself. So the same as the corporation piece where the company gets a deduction. But in the ESOP scenario, also the percentage of the company that's owned by the ESOP, because it's an S Corp, is not taxable. So we showed how the money flowed earlier, where we make a contribution to the ESOP and the ESOP uses that money to repay the loan. Well, when you're an S Corp ESOP, we can make a distribution that would have otherwise gone to pay taxes. And if we're a minority S Corp, we still have to make the distributions to the tax-paying partners as tax distributions. So at the end of the day, what we end up doing is we make a distribution to the shareholders. The ESOP uses that distribution now to repay the loan, and that's dollar for dollar tax benefits. So in this example, I'm not going to go through the math right now, but in this example, if you go through all the math, we end up with, let's see, I had it here. Yeah, the 1.5 million total debt service was paid for by tax savings. So either the tax deduction or the direct tax benefit of the tax distribution. So it was about 70% of the benefit was paid for with taxes, or 70% of the value that's being paid, ultimately paid to the shareholders, being paid out of tax savings. This is the numerical example of that, and you can just see how much of it was net cost in the blue versus net tax benefit. Obviously, in the ESOP equation, taxes are paying for a significant amount of the value that's going out to the shareholders. And then finally, the benefit to the company in an S corporation where you're 100% owned is you don't pay any state or federal income taxes. We have a couple more, John, I'm going to skip over this. We have a couple more examples, and then we have just the benefits to the different professionals in the world, which obviously financial planners, it's an opportunity to get cash from the exit transaction itself. Banks, again, they love to do ESOP transactions because they keep a client, they end up creating a new lending relationship. And again, the downturn showed that ESOP companies default much less than non-ESOP companies. Accountants typically, once they get to know ESOPs, if they don't know them, love them because it's another audit. If you have over 100 employees, you have to audit the plan. And oftentimes the ESOP trustee will want another level of review for the company itself. And then again, some pictures here, I'll let people read these, but this shows kind of how ESOPs did through the pandemic and so forth. So I'm going to stop there and let's get on to the questions if we still have time.
Yeah, perfect. Thank you, Mark. So there were a few in here that I just kept because I thought that would be good for the end. One of the good ones in here. So this is a good for just from a size standpoint of, for employee size, like, is there a minimum number, like, for example, 30? Is that like an ESOP requirement, or is it just more likely that was the example that was provided?
No.
There it is.
Yeah, we didn't get to it, but I'll throw it up on the screen here. Yeah, so the really from a minimum employees, we need to have, if too much of the ownership is concentrated into few employees, it can become a problem. So we really say to do an ESOP, you really need 20 to 25 employees at least. If you're a C corporation, it's maybe smaller, but that kind of handcuffs you down the road unless you grow bigger. So we really, we can do the analysis if you're smaller than that and let you know whether it makes sense or not. But generally speaking, 20 to 25 employees. Obviously, the company needs to be profitable to take advantage of tax savings. Trusting environment, and we kind of look at the minimum size as kind of the $2 million transaction or more, really to make it make sense. I would say, generally speaking, from an EBITDA perspective, it's probably $1 million or more in EBITDA for an ESOP transaction to make sense. So those are kind of the minimum size ranges that we look at.
Okay, and there were a slew of questions that have just come in here. Let's see. So it was funny because actually one of the questions got answered, or that got asked a couple minutes ago, was the same thing about what's the smallest size company. So pretty much that'll cover that. One of the next ones in here, Chris is asking, is an ESOP transaction compatible with QSBS?
QSBS, you got to help me with that one.
Chris, if you want to type that into the chat, we can come back to that. If you could put that in there for us, we'll come back to it.
Too many acronyms in our world.
Okay, so here's a couple of acronyms that we've been talked about today from that Thomas is asking about. So these tax benefits for ESOPs are only compared to C Corps, correct? So if an S Corp or an LLC, LLP is being sold, there are no tax savings, correct?
Well, no, because even though the S Corp or the LLC doesn't pay the taxes directly, the shareholders are still paying the tax. So an S Corp that's owned by individuals, you and I, we're actually paying a higher tax rate than corporations at this point. It's a flow through tax. So that's why I talked earlier about tax distributions from the S Corp. So the way we would look at it is what's the tax cost of running the business, whether the shareholders pay it or whether the company pays it. So there still is a tax savings. It's just who has to pay it, I guess, effectively.
Perfect. Okay, so got some responses about QSBS. It is qualified small business stock.
Okay, sorry. Yeah, got it. So the Small Business Administration has made some changes recently that are allowing more. It was allowed before, but with some restrictions. So but it's even friendlier now. So you can still be a qualified small business and be an ESOP. I'm frankly not the expert in our firm on that, since I didn't even know the acronym. That's maybe obvious, but no, it is something that can be used in conjunction with an ESOP.
Okay, and then this is a good one. So how and who does annual valuations?
So the trustee will hire their own independent third-party valuation firm, and that's the firm that does the valuations themselves. So they need to be qualified. Trustees have a list of valuation firms that they believe are qualified, that have been through their system, but it's a third-party qualified independent trustee. It cannot be anyone that's done any work for the company or the shareholders, I think, within the prior 5 years. So that's one of the things, that there's a kind of a hard and fast rule out there from the DOL that they don't want it to be, somebody doing a valuation every year for the owner and then all of a sudden becoming the trustee's valuation firm.
Perfect. Okay, and we got time for a couple more, but this is a good one. This is like a 3-part that Sarah's asking. Okay. Why do so few eligible companies participate in ESOPs? Is it mostly due just to lack of awareness, or are they just not educated appropriately? And then what's the first step with that?
Yeah, I think it is. A lot of it is awareness. Again, one of the reasons we have the myths section in here is there's a lot of misunderstandings about ESOPs and misperceptions. So we try to, relieve some of those issues, but I think there's a lot of misconceptions. And I think, still, unfortunately, after almost 50 years of ESOPs being part of our, legislative history in America and having them available, they're just not talked about that much. I mean, when people think about leaving the business, they think about intergenerational transfers or sales to third parties, whether it's private equity or strategic. So I think it's just not enough education on it yet. Hopefully that's changing, but
Okay, we got time for one more. Brian's asking, if you are looking at an ESOP but have a significant portion of your workforce close to retirement, can that cause a cash concern after an ESOP close?
yeah, great question. We'll try not to get too into the weeds here, but basically the way the allocation of shares occurs is it's all starts from day one. So if you have somebody that's 63 years old and they plan on working till they're 65, well, they only have 2 years left to get allocations before their retirement. So even though they're going to retire sooner and have a potential payout earlier than they would if they were younger, they only have 2 years to get to accrue benefits under the plan. So that's the first part of it. And like I said, sometimes the allocations will occur over a 20-year period. That's probably normal for a 100% ESOP is a 20-year payout. So the first part of the answer is no, because they don't have enough time to accrue a large enough account balance. Second part of the answer is when someone retires at normal retirement age, you actually have 5 years to pay them out. So it's part of what they wrote into the legislation, trying to not get ESOP owned companies too cash strapped. So even if that person were to retire and had a large cash balance, you can pay them out over a 5-year period. What I can tell you is, again, early years, cash balances and payouts are not as big of a deal because people haven't accrued enough benefit yet. But typically after, say, 5 to 10 years, what you want to do is be doing a regular repurchase obligation study. That is a study that actually looks at the age of each of your employees, their account balance, their projected account balance at retirement, and what that cash need will be. And ideally, by the time this is an issue for you, you're 100% S-owned ESOP and you're not paying any taxes at all. And you're able to put aside some of that tax savings every year. So to make sure that you always have a nice slush fund to buy out those retiring employees. That's the way most companies operate, and obviously successfully so.
Perfect. All right. Well, we're pretty much at the top of the hour now. Mark, thank you very much. That was definitely informational. Tons of questions come through. So glad that people could get everything answered as well. A couple things that, again, I wanted to mention, it did pop up in the chat. If you do want these slides, Mark is happy to share these with you after this webinar. On top of that, again, Mark, thank you for joining us today and talking about this, pretty broad topic, but definitely one that definitely needs a little bit more attention. So really appreciate that.
Right.
Just another reminder. Yep.
I'm happy to take phone calls as well. If your question didn't get answered, give me a call or shoot me an email, and I'm happy to talk to anybody that has any questions.
Awesome. Thank you, Mark. And with that, just a reminder, we'll be back on the 25th of July with Pradeep Senga. He's going to be talking about how to get more done in less time without burning out. So that'll be on July 25th. That's our next webinar. Again, Mark, thank you for joining us today, and we will see you all on the 25th. Take care, everyone.
Thanks, everybody. Bye.